Thank you so much for coming on. Really appreciate your time. I know that some of our listeners will eventually love to hear what you have to share. So if you wouldn't mind just kind of giving me an overview of who you are, tell me a little bit more about Roosevelt Capital Management and kind of the services you provide to your clients.
Sure. So Roosevelt Capital Management is an asset management firm. Our bread and butter, the area that we really are very focused on adding value is within income strategies. So fixed income and cash. That being said, we also do equities, but primarily fixed income and cash. So that's about Roosevelt Capital Management.
Awesome. And now I know we've had conversations in the past, so I loved hearing kind of the genesis story of Roosevelt. Would you mind just sharing a little bit about your background, how you got to creating Roosevelt Capital Management? Because I know you have a ton of experience.
Sure. So I graduated from college in 1993. First job out of college was with BlackRock. When I joined them, they were pretty small. Today, they're the largest asset manager in the world. After BlackRock, I worked in private equity, all in New York City, and then went back to business school. And after business school, worked at Morgan Stanley, where I was a credit default swap trader, and then moved over to the desk that manages the firm's loan risk, which was a $60 billion long portfolio with about $30 billion of shorts. So we were effectively a long-short credit hedge fund within Morgan Stanley. Left Morgan Stanley after the global financial crisis in 2009. I lived outside of the city. My wife felt like a single mom and didn't feel like she had a husband. So I realized it was time to move back to an environment where I could be an engaged husband and father. So moved back to Dallas, where I went to work for my family's family office. My father has been in the oil and gas business for his entire career. So I joined that platform with the primary mandate of managing the family's liquidity bucket. So began managing that in 2009. Had other families and third parties come to us and say, hey, would you manage our liquidity the way you're managing your families? And the answer was no, we can't, because we are, in order to manage third-party capital, you have to be regulated. And we had no interest in having the family office become regulated. So continue to have people ask. And so about 4 years ago, separate and distinct from the family business, I created a platform, created a legal entity that became regulated, separate and distinct from the family, called the legal structure as an RIA, Registered Investment Advisor.
Okay.
That would allow us to begin taking third-party capital. So today we have approximately 80 clients, 130 accounts. So that's a little bit about the background and why we created Roosevelt Capital Management.
I know that when you're managing cash, there's so many other factors that you need to consider, right? You got to think about the duration. When are we likely going to need this cash? You know, is it more so just permanent capital? Is it, do you have capital calls coming up that you need to be kind of managing more short-term focused so that you're not losing value due to inflation? So I know that based on your services and managing liquidity, there's a whole bunch of things that can go into that, right? Would you mind just sharing a little bit about your philosophy for managing liquidity? You don't have to give away your secret sauce, but maybe share a little bit about your strategy.
Well, Dom, you already alluded to the most important variable when you're considering how to allocate capital, and that is your time horizon. I think most thoughtful investors are happy to acknowledge that the future is inherently unknowable. But there are some things that are absolutely knowable, assuming the United States continues to exist, which we all believe it will, indefinitely into the future. And what are those things? We absolutely know that equities will beat fixed income, and fixed income will beat cash. Those are just a fact. Why is that? Because when you are taking equity risk, you're lowering the capital structure. You don't have a defined cash flow stream. So without getting into a whole bunch of financial theory, but there are also some other things we do know. Equities will be more volatile, and tend to have higher drawdowns than fixed income. And fixed income will be more volatile and have higher drawdowns than cash. So why is it then that somebody would allocate capital to one extreme, cash, or another extreme, equities? Well, when you're allocating capital to equities, again, you're going to get a higher return. But, if I have, a down payment on a house to make in a year or something like that, if I go out and put that money in equities, I'm subjecting myself to the risk that I could be down 56% next year, like happened in the global financial crisis. So if you have a need that's in the near-term horizon, one would be foolish to deploy that capital in an asset that has certain characteristics like significant volatility and drawdown risk. So one must always match the mandate of the capital with the characteristic of the asset that one is investing it in. So yeah, you alluded to that, and that is the first and foremost the most important thing that must be understood when allocating capital. Let's just put a stake on the ground.
Yeah,
the most important thing when investing is matching the mandate on the capital with the risk characteristics of the asset you're investing in. So you asked about philosophy. First and foremost, that is what we think about when we are allocating somebody's capital.
What would be some of the things that you would want to ask a potential client for to determine whether or not they should be managing for the near term or can push it out a little bit on the horizon?
So it's a great question. Again, none of us know what the future is and what the future holds. So what do we ask? Help us understand your buckets of capital. In other words, are you saving for anything in the near term? Do you have a liability that might be in the near term? What happens oftentimes when we're talking to older folks or medium-aged folks, they say, nope, got everything covered. But even if you have everything covered, right, there are unforeseen circumstances. And because of those unforeseen circumstances, one should always have some form of reserves in the event that something happens in an unexpected fashion. That being said, we also have clients who are large family offices, and they have the venture capital portfolio, they have their hedge fund portfolio, they have their private equity portfolio, they have a lot of assets, whether it's in real estate or in oil and gas, that are generating a lot of income. So those are assets that we will take into account when we're actually helping them create a strategy. Because when you have even equity-like risk or that are generating significant cash flow, you don't necessarily need a whole lot of cash because your portfolio is throwing off a lot of cash.
Sure, but when your cash reserves start to accumulate, you don't want them just sitting in a bank, right? You really want them to put to work. Do you want to share any materials you may have from Roosevelt that could be beneficial?
But would be happy to do that. So we have 13-year audited, verified track records in the fixed income space. And I'd be happy to show you kind of our unconstrained portfolio performance. So this is our unconstrained fixed income performance. And over the last 12 months, you can see we're up a little over 9%. These are all net returns. And we're just comparing our performance versus kind of the major pillars of the fixed income space: corporate bonds, the overall bond market, which is just the Barclays Agg, the Bloomberg Barclays Agg, mortgage bonds, government bonds. And if we kind of roll that back, as I mentioned, our audited or verified track record here is over 13 years. So that's the last 12 months. Let's see if I can scroll through that a little bit. Yeah. So that's the last 3 years. Same story.
Yep.
the last 5 years, the last 7 years, 10 years, and since inception. And,
Wow.
I'd say that, and you can see just like over the last 7 years, right? We didn't really have interest in the interest rate markets until recently. And we were very thankful that we were able to generate significant performance. So that's just our unconstrained fixed income portfolio. And a lot of people will say, okay, how did you generate that performance? And the outperformance is really not by accident. We've been doing this for about 30 years now. And so we've been fortunate just to learn a few things based upon some experience. So I'd say the 4 pillars of value add, first and foremost, would just be asset allocation. Where is the fat pitch within the fixed income markets? And we're constantly monitoring every single sector of the market and asking, where's the best risk reward at the moment? So number one, asset allocation. And then number 2, within kind of the best sector, we ask ourselves the question, what are the best securities? So security selection would be the next leg of our value add stool. And when we're thinking about security selection, we're thinking about what bonds offer the lowest risk of loss on a risk-adjusted basis, and what bonds are offering the highest reward from a yield or potential return perspective. So security selection is the second leg of the stool. The third leg of the stool is portfolio construction. Portfolio construction, most portfolios today in the fixed income market are passively managed. In other words, you're just buying, an ETF or a mutual fund that has hundreds, if not thousands, of securities in it. And nothing wrong with that. But there's a but. And the but is, why own 1,000 securities when you can own the best 50? And
Right.
we really, through portfolio construction, we're avoiding something called, and other people have used this term before, diversification. There's real value in diversification, but taken to an extreme, you actually end up in a diversification posture. So we are actively working to avoid diversification. So that would be the third leg of the stool, portfolio construction. And then the fourth leg of the stool, Dom, would be what we call portfolio optimization. And that is within a portfolio. There's a financial truth, mathematical / financial truth within the fixed income markets. And that is, if you own a security and you can sell it to buy a higher yielding security, all things equal. And when I say all things equal, I mean your default risk is the same, relatively speaking, and your interest rate risk is the same, relatively speaking. You should always do that. And our process and our systems are always looking for those opportunities to sell positions within a client portfolio at a lower yield, to allocate that capital to another security that has comparable risk characteristics that is trading in a higher yield. And so that would be the fourth leg of the value add tool called portfolio optimization. And through those 4 legs of the stool, just to summarize them again: asset allocation, security selection, portfolio construction, and portfolio optimization. Because we are actively doing those things every single day in our client portfolios, we are very fortunate that we've been able to have performance that significantly exceeds the major kind of benchmarks within the fixed income market. So that's our performance in our unconstrained fixed income portfolio. And that portfolio is designed for clients who have capital that They don't want to allocate to the equity markets because of the drawdown risk, because of the volatility. But at the same time, it's not cash either. The major clients in that strategy, we have a lot of family offices, we actually have, interestingly enough, corporations. And we have just long-term cash reserves that have allocated capital into those strategies. So that's the unconstrained fixed income portfolio.
That's awesome. Yeah, I always enjoy like hearing about this because I feel like I always take something away every time we talk, right? I think that a lot of times people can overcomplicate things and try to pick their own securities without really kind of understanding the underlying dynamics of them. But I think from your guys' technical perspective, given your background and the technology that you guys have invested in to constantly monitor each individual client's portfolio and reposition and optimize accordingly. I think that's awesome. Maybe, I don't know if you want to share on this. You don't have to. I can always take it out. But if you wanted to, maybe tell a little bit about kind of how your investment in technology really is what is separating you apart from your peers.
Yeah. So I have a wonderful partner in this business by the name of Mike O'Brien. And Mike is also in his early 50s, has a lot of scar tissue, like me. He's been an entrepreneur, and I would call Mike the secret sauce behind Roosevelt Capital Management. Mike, before he and I joined forces, was building customized software for Dell and AMD. Not as an employee, he has a consulting firm. And so by really just solving problems that we have had, right? So when I left my family's family office to do this full time, going from one portfolio to just managing 5 portfolios was a significant step, because when you're managing one portfolio, it's really easy to just go through one, set of financial statements and kind of say, well, what should I be doing here and there? But as you start expanding this to multiple clients, multiple strategies, it becomes very complicated very, very quickly. So Mike has built truly world-class systems and processes that allow us to do what we do at scale for our clients in separately managed accounts. And let me just digress just for a second. When we were creating Roosevelt Capital Management, the very first node we came to was, do we want to offer what we do to third-party clients in the form of a fund or in the form of separately managed accounts? And we said, ultimately, it's going to be a lot more difficult to do this in the form of separately managed accounts, but ultimately it's much better for the client. And because it's much better for the client, that's what we ended up doing. So why is a separately managed account better for clients? First and foremost, total transparency. They can log in to their Schwab account or Fidelity account, and literally it is a Schwab or Fidelity account, just like we all might set up on our own. And what that client does, although we set up the account on their behalf to the extent that they don't already have one, so we do all the work, we just have a limited power of attorney that allows us to buy and sell securities in that account. So we don't have the ability to move securities in or out of the account, to move cash in or out of the account. And that makes clients feel a lot better in this era of, cybersecurity risk, wire fraud risk.
Absolutely.
So they have total transparency. They can see exactly what they're doing. As a matter of fact, every single time we do a trade in their account, they get an email to the extent that they want it that says, Roosevelt Capital Management sold this and bought this in your account. So total transparency, number one. Number two, total accountability. Our clients have the ability, pursuant to the investment management agreement that controls our relationship, to effectively terminate us immediately. Now, let me just add, since we've been managing third-party capital, we've never lost a client. And almost every single one of our clients have given us more money. But we love the fact, and our clients love the fact, that we are accountable for our performance, for our responsiveness, for our client service. We don't answer calls quickly. They have the ability just to say, these guys are not thinking about me. They're not meeting my needs. Let me pull the plug, call up Schwab, ask them for another manager to manage this account or liquidate this account on my behalf. Now, that's never happened, but clients have the ability to hold us accountable that way. So separately managed accounts give clients all the power, give clients all the transparency. And, as a former family office guy, who our family offices had investments in, private equity funds and hedge funds and venture capital funds, there's a lot of fine print in those agreements. And you can you might be gated. There are a lot of things that can happen. That the beautiful thing about this is nobody who we're managing capital for is going to impact you. So we might have one client who's like, I'm really fearful of the market. I want to pull capital out of the strategy. Other clients saying, hey, I love what's happening. It's time to double down. Well, if you're a fund, what one client does impacts you. What your fellow limited partner does, who has a mandate and a strategy that you don't necessarily, or objectives you don't necessarily understand, what that person does will impact you. In a separately managed account, nobody impacts you in your account except you. So that's why we went the separately managed account route. And there's huge technology investment that we've had to invest just in order to do that really well. If you go to a JP Morgan, a Wells Fargo, these PIMCO, BlackRock, and say, I want you to manage a separately managed account for me, and I want you to actively manage it the way a Roosevelt Capital Management does, it was sure, happy to do so. Minimum account size would be, $25 million. Now, I'm sure they'd do smaller accounts, but they wouldn't be actively managed. So to create the value we create in separately managed accounts, it's just been we've developed technology to allow ourselves to do that, not only for the large accounts, but also the smaller accounts.
Yeah, and I love that, because when you're creating a bespoke, customized solution for people, it gives them peace of mind knowing that they're not going to get some generalized investment advice. It's custom tailored, specific to their needs, whatever their capital buckets are, right? Their needs, and to be managed actively. That's great. And I love that. Maybe we could talk a little bit about your ideal client. I know that we had touched base on it in the beginning, whether it's a family office, corporations even. Could you tell me kind of what your minimum is for your different strategies? And then obviously there's no maximum unless you got a couple billion you want to manage. But yeah, tell me a little bit about what it takes to get started with you guys.
Yeah. So you asked about the ideal client, and the ideal client is really a function of the mandate. And we walked through one mandate very specifically, which was our kind of unconstrained fixed income mandate. But we also have another, we have a couple other mandates, equities and cash. And let's just delve into cash just for a second, just because the world has changed dramatically, really, in the last year or so, because of the significant inflation that our economy has experienced. It's resulted in interest rates at rising significantly. So there really wasn't an opportunity cost in holding cash for a significant amount of time, years, as a matter of fact. And as a result, having millions of dollars sitting in a bank account or some other type of account, a brokerage account, there was no opportunity cost associated with that. Today, again, given the rise in the Fed fund rate front end of the curve, there is a significant opportunity cost in holding cash at a bank. And so I would say, Dom, the area that we have grown most quickly is, and this was really client push. We've had a number of clients come to us and say, hey, we are sitting on a lot of cash. We want it to stay liquid. We don't know when we're going to need it. Is there anything that you can do for us there? So we have taken kind of that framework that I mentioned of value add, asset allocation, security selection, portfolio construction, and portfolio optimization, and we have applied it to the cash market. So what we are doing now is we are investing people's cash. When I say cash, let's just define what cash is. GAAP says if you own securities that are on your balance sheet that have a maturity of less than 90 days, you can hold that on your balance sheet as cash. Now, that's a technical definition for cash. There are also a number of folks who say, if you have securities that mature within 180 days, you can put that on your balance sheet as short-term investments. A lot of people say, that's the same thing as cash to me. I don't really care. If I own a treasury bond that matures in 150 days or 179 days, that's cash. So we've applied that framework to our understanding of the markets, specifically our understanding of the U.S. Treasury market, to create a cash product. And what we have found, Dom, is that this cash product, people have been flocking to it for really three reasons. Number one, we're getting much higher returns than really what any bank can provide. But there are also a lot of other bank products out there that, we've all been seeing a whole bunch of teaser rates from a lot of banks. Mm-hmm. We're finding that this cash product generates higher returns than, all these teaser rates that we see, as well as really higher returning money market funds in the market. So number one, this cash product, higher returns. Number two, lower risk. And you're like, well, geez, how does a cash product at a bank have risk? Let's talk about that for a second. When Silicon Valley Bank failed, most people who are listening to this podcast have probably heard of the company called Roku. Roku had over $400 million of cash at Silicon Valley Bank. When Silicon Valley Bank was put into receivership, you can imagine that the executives at Roku became very concerned very quickly. And fortunately for them, that cash was returned to them. But for a window of time, it was questionable whether it would be, because the FDIC only provides insurance on a relationship at a bank up to $250,000. So anything over $250,000, the depositor is actually taking effectively senior unsecured risk to that financial institution, that banking institution. So let me ask you, Dom, what would you prefer to have, more than $250,000 in a bank paying you a poor rate, or money sitting in a U.S. Treasury that's paying you a great rate, and all of it is effectively insured by the U.S. government? I would always prefer the latter.
Yeah, same. I mean, you're not getting compensated to keep it in the bank, for the risk you're taking, for sure. So
yeah, so we keep it incredibly simple. We keep people's cash in U.S. Treasuries. Really simple. So the safest security in the world. Number two, because it's in a U.S. Treasury, 100% of it is effectively insured by the U.S. government. What's really interesting, too, is by having it in a U.S. Treasury, we're actually returning people a much higher return than they would get otherwise. What do banks do? Whether it's a 1-month CD or a 6-month CD, we've all heard about these kind of IC type products. You have one relationship with one bank and they farm out your money to 100 different, banks, $250,000 in each bank. So you have the risk. You don't have the risk of the senior unsecured risk of a bank. But I guarantee you, you're not getting paid a great rate. You might be getting paid a 3.5, 4 in this market. Why do that when you can just go invest in a U.S. Treasury security? And today, we're allocating capital as high as 5.4%. So
Wow.
We're providing higher returns and less risk. And people will say, well, what about liquidity? If I own a Treasury security, well, the beautiful thing, the U.S. Treasury has $9 trillion of securities that mature in the next 12 months. These securities are issued to the tunes of hundreds of billions of dollars. We can provide people same-day liquidity with that. So literally, they can call us and say, I need my money, or I've got $10 million in your strategy and I need $3 million of it right now. Great. We just go sell that Treasury security with same-day settlement, and the money should be hitting the account in the next 15 minutes. And the client literally goes into their Schwab account, Fidelity account, and wires that $3 million out. They have it as turnkey. So who is interested in that product? What we are finding, God, in that.
Yeah, everybody's interested in that one. Yeah.
But here's the thing we have found most interesting about that product. We started because of client push. Clients coming to us and saying, hey, we trust you as our fixed income. You guys do what you say you're going to do. Can you help us figure this cash thing out? And what we have found, we thought people were going to like this because of the higher return, lower risk. But what we have found is the reason people have really liked this product is because they no longer have to think about cash management. They know they have guys who are looking at their portfolio 24/7, 365. They know that they can have access to it immediately. They know that we are just, as a part of our process, allocating that capital to the best place within the U.S. Treasury market that meets the constraints that we have mutually agreed to. And as a result, so what we're doing is that we're actually providing people much higher returns, much lower risk. And what's turned out that the thing that they really love, we've taken a major headache off their plate. Because just like anything, the world is a complex world. We are all experts in a very, very, very narrow bandwidth. And so we have a lot of clients who are corporations who, they want to think about making their widgets or distributing their widgets or making their widgets better. What they don't want to think about is cash. They just want to know that somebody's thinking about it so that it is secure, they're getting a great return on it, and then they can have it as they need it. So we have found corporations like that product, family offices like that product, high net worth individuals like that product.
Awesome. So as far as account minimums go, do you have any specific criteria for whether it's the unconstrained, the equities, or the cash management that you could share?
Yeah, sure. So in the cash management, as well as the fixed income, our minimums are $250,000 per account. Equities are the same. So we just try to keep things incredibly simple for folks.
Sure. That's great. I know there's a lot of people that are going to be really excited to hear about your guys' service offering. So with that, how can people get in touch with you guys?
So email david.roosevelt@rooseveltcapitalmanagement.com, michael.o'brien@rooseveltcapitalmanagement.com. Or, one of the other things that we really pride ourselves on, Dom, is just responsiveness. So my cell phone's 214-796-5158. Somebody shoots me a text, we'll get back to them very quickly.
Perfect. That's great. Well, David, I really appreciate it. Was there anything else that you'd like to share just before, we wrap things up?
Yeah, Dom, I'm just grateful to know you. Grateful for the relationship. And thank you so much for having me on your podcast. Grateful for the time. And thank you very much.